Picture this. The Bank of England has raised interest rates 14 times in succession. A chilling fact, isn't it? The central bank has been on a mission, consistently raising rates since December 2021 to combat high inflation, which currently stands at a staggering 6.7%. It's like a rising tide, slowly but surely making its presence felt. Now you may be wondering, why the hike? Well, high inflation is a beast that needs to be tamed. When prices rise too quickly, the value of money falls and the economy can spin out of control. So the Bank of England uses interest rates as a tool, a lever if you will, to keep inflation in check. But every action has a reaction, and this rising tide of interest rates has had a ripple effect across the UK. If you're a mortgage holder, you've probably felt it. Those on tracker or variable mortgages have seen immediate increases in their payments. Yes, that means your monthly mortgage payment has likely gone up. But it's not just mortgages that are affected. Savings rates have risen, but they still remain below inflation, prompting some to consider using their savings to pay off debts or make mortgage overpayments. Personal loan and credit card rates have also increased in response to the bank's moves. So, if you're on a variable mortgage, you're probably feeling the pinch. But what about those on fixed-rate mortgages? Let's dive in. Now, those on fixed-rate mortgages might be feeling a bit smug right now, but should they be? Let's delve into this. Currently, fixed-rate mortgage holders are somewhat insulated from the immediate impact of rising interest rates. Their mortgage payments remain the same for the duration of their fixed term, regardless of any rate changes. But here's the rub. Once that fixed term ends, they could face higher payments if they need to refinance their mortgage at a higher rate. Now let's talk about savings rates. They've risen, yes, but they still lag behind inflation. This means that the real value of your savings is eroding over time. So what are some people doing? Some are considering using their savings to pay off debts or make overpayments on their mortgage. It's a way to get a better return on their money than they would by leaving it in a savings account. But remember, this is not a one-size-fits-all recommendation. Everyone's financial situation is unique, and what works for one person might not work for another. It's always a good idea to speak with a financial advisor before making any major financial decisions. In conclusion, being on a fixed-rate mortgage doesn't mean you're immune to the effects of rising interest rates. When your fixed term ends, you might have to deal with higher payments. And if you have savings, consider whether they're working hard enough for you in this high-rate environment. So, even if you're on a fixed-rate mortgage, the rising tide of interest rates has implications for you. Think you're safe because you don't have a mortgage? Think again. In the wake of the Bank of England's decisions, personal loan and credit card rates have followed suit, and they're on the rise too. It's a domino effect, really. As the base interest rate climbs, so do the rates of these financial tools. So if you're carrying a balance on your credit card or have a personal loan, you might find yourself paying more in interest than you were before. But it's not all doom and gloom. There's a silver lining to this cloud of rising interest rates, especially for those planning for retirement. An increase in the base rate can be a boon for those looking to buy an annuity. As rates rise, so does the income you can secure from an annuity. In essence, you could lock in a higher income for life. Now, isn't that a comforting thought amidst the financial upheaval? A secure retirement income is a lifeline for many, and these rising rates could mean a more comfortable future for those on the brink of their golden years. But what about those who aren't looking to retire just yet? Well, they'll need to be savvy and strategic. Perhaps it's time to reconsider how we manage our debts and finances. Maybe it's time to pay off high-interest debts or consider other forms of borrowing. So, whether you're looking to retire or just get by, these rising interest rates are something to keep an eye on. So what does all this mean for the housing market? Hold on to your hats, folks. The housing market is a complex beast, influenced by a myriad of factors such as employment rates, wages, borrowing costs, and lending availability. Now, with the recent increase in mortgage rates, affordability has taken a hit. Pair that with the ongoing cost of living crisis, and it's like a 1-2 punch for potential home buyers. But what does this mean in practical terms? Well, it's likely to lead to a slowdown in the housing market. The surge in property prices that we've become accustomed to may ease over the coming years. However, affordability is expected to worsen as homes become less affordable due to rising interest rates and high property values. The Bank of England has been raising rates since December 2021 to combat high inflation, which currently stands at 6.7%. This decision will impact future homeowners, with those on tracker or variable mortgages seeing immediate increases in their payments. So, in a nutshell, the housing market is in for a bumpy ride, but what can you do about it? With all this talk of rising interest rates, it's easy to feel overwhelmed. But knowledge is power. It's crucial to stay informed about these changes and understand how they can impact your financial situation. Whether it's your mortgage, personal loans, or credit cards, every aspect of your finances could be affected. If you're uncertain, don't hesitate to seek professional advice. Knowledge isn't just power, it's the compass that guides us through the stormy seas of finance. Stay informed, stay savvy, and don't forget to subscribe and comment below. Let's navigate these financial waters together.